Hello, everybody. Good morning, good afternoon, wherever you are in the world, and welcome to this Panax webinar on cash forecasting, a look into the future. My name is Naomi Goldberg. I'm the new PMM here at Panax, and I'm delighted to introduce you to our two special guests today. We have Adi Barak, who is the VP Product here at Panax, and we have Joel Jeselsohn, who is the CFO at Tangoe, and we're going to be talking all about forecasting, AI, automation, and how we can make your lives that little bit easier. So just a few housekeeping rules to get started. This webinar is recorded, as you could hear at the beginning, and we'll be sending out the recording to you afterwards. You are welcome to put questions in the chat. We'll try our best to get to as many of them as we can. If we don't get to your question, we'll send out the answer by email afterwards. And feel free to share this with anyone that you think it can be helpful or relevant for. Okay, so we are just on time, so we're going to get started. We are going to be discussing cash forecasting. And Joel, I'd like to ask you if you could tell me a little bit about what the current global financial climate looks like, what it's looked like for the past few years, and what that means for finance teams.
Yeah, thank you, Naomi. Happy to be here and participate in this exciting webinar. As we know, the economic climate globally took a hit during COVID, and as the world started to recover, we were hit by inflation that required central banks to increase the interest rate significantly. Initially, the job market was weak, but it has recovered since. At the same time, companies were forced to work remote, and even as many started to come back to the office, we heard just this morning Amazon announced they were going back for 5 days a week. Hybrid work or full remote work is here to stay, in my opinion. All of that had a significant impact on teams in general and finance team in particular. People have more flexibility, and the satisfaction is no longer just about the specific work you do, but also the ability to have that flexibility. The need to have automated system hosted in the cloud to allow for remote collaboration caused an influx in SaaS solutions. And that is true across the board, not only in finance. However, when it comes to finance, which brings us to today's webinar, the high interest rates and with that the challenges to raise money or establish credit lines made accurate and timely treasury and cash management a priority.
Okay, thank you. And Adi, would you be able to tell me, what does cash forecasting look like to you right now with everything going on? Are companies really on top of their cash forecasting? Is it a particular challenge that companies are facing?
Yeah, so I think as a follow-up to what Joel was saying, companies need to be prepared to foresee upcoming drops or increases in their balances to make sure that the amount that they're keeping in their operating cash is as optimized as they can make it. If they can foresee an increase in cash that is not required for an ongoing operating activity, they can use the opportunity and invest it in this market, right? And earn more interest or gain money out of it. And the other way around, anticipating drops in cash and knowing to more accurately foresee when to pull money from your credit line allows for additional optimization. All of this can be achieved with detailed and cash-driven forecast that is granulated enough to understand what are your actual needs and gain insight out of it and make sure to make better cash decisions for your business.
Thank you, Adi. Yes, so cash forecasting is super important with all the uncertainty that we have going on. And Joel, how important would you say it is for mid-sized companies? Does this change the importance of forecasting?
I think, cash is king, and that's true for any type of organization. In environments such as today, it's also critical to assess the needs of the organization and to only use the resources as needed. Taking a loan when it's not needed can be a significant burden on an organization, especially on mid to small size companies. And this is true. I mean, the issue with the loan is true for any size company. The problems might be different, though. What I mean by that is for a small to mid size, The cash needs may not be as high compared to a large enterprise simply because of the size of the enterprise itself, but the margin of error is smaller as well. Any mistake can be significant or can have a significant impact on the company's bottom line and cash outlays. They simply don't have the scale to allow for errors in the forecast. Large enterprises with deeper pockets may be able to tolerate some level of inaccuracy, but the errors can cause significant fluctuations. Therefore, accurate cash forecasting is important regardless of size, and especially critical at a high interest environment. You don't want to take a loan, as I said, when it's not needed. At the same time, you want to be able to park the money in high interest bearing accounts if you can. That may be different now with the interest rates starting to come down, but to do all that, you do need accurate cash forecasting.
Right. So it's very, very important for these mid-sized companies. Adi, do you have anything else to add to that?
No, I think as Joel was saying, this is what we're seeing from our customers as well, needing to be on top of your cash on a weekly basis and have a granular forecast allowed to achieve exactly what we discussed in making sure your cash is optimized. And small businesses or smaller businesses in particular or need this requirement, need this to be able to achieve better management of their cash, especially in lean teams where there is maybe less people overseeing the cash on an ongoing basis, and there's a need in making sure that decisions are being made in a more tight environment where things need to be done quickly and by less people.
Yeah, so it's a little bit of a contradiction in a way, because it's those smaller teams that really need to be doing the forecasting to make sure that they're on top of every penny or every pound or every cent. But it's also those teams who are kind of struggling and have a lot going on their plate at the same time. So it can be tricky. Joel, can I ask you about, we're going to talk a little bit about automation in cash forecasting. Can you tell me a little bit about what you see as the advantages of using automation in cash forecasting?
Yes, absolutely. So I can list a few advantages by using an automated platform and automated cash forecasting. So manual work is prone for errors. This is true and a problem that is true for everybody. Still, automation will minimize that. Secondly, more importantly, automation, to me at least, is about efficiency and cost avoidance. You can do more with less, whether it's to do more with the existing staff that you have, as Adi said, with smaller teams, is important to be able to maximize the work output. On top of that, you can provide the team members with the ability to upskill. Instead of doing data entry and maintaining manual spreadsheets, they can focus on data analytics, which is a higher level task, I would say, so give them a better job satisfaction. They can start asking the right questions simply because they have the time to look at the data. So the value add for the business is clear. It also creates a high level of job satisfaction. It allows for ad hoc reporting and real-time decision-making, and this is very important in businesses that are fast evolving. And finally, the emergence of AI makes automation a critical requirement in order for us to be able to benefit from AI capabilities. And I'm sure we'll get into AI later in the discussion today.
Of course, how could we have a webinar where we don't talk about AI? Of course, we will be including it. Adi, can you tell us from our customers? Obviously, Panax has automation for the cash forecasting, and that's one of the major values. How have you seen our customers using it and benefiting from it?
Yes, I think as Joel was saying, one of the major challenges in forecasting is making sure that the inputting of the data is streamlined. Many of our customers managing multiple banks across the world with multiple accounts in each of them, and just the process of getting the data from each of these banks and inputting this into a forecast is already a tedious and time-consuming process, especially if you need to roll a forecast on a weekly basis and adjust it in an ongoing fashion. We see teams that in the past invested hours every week in just creating a model that can get them in a place where they can make a decision based on it. So the first piece of automation is about just getting this data, analyzing it, and pushing it into a model where the teams can now, as Joel said, change their focus from working on adding data to actually looking at the data and understanding it and making actual decisions based on insights that are more easily appearing to them in the system. So I think that's a major part. Another piece in the way there is understanding this data. It's not just about inputting it, it's inputting it to the right place in the forecast, analyzing thousands of transactions and understanding whether a specific transaction is correlated to a collection or an intercompany, for example, can make a big difference in your forecast and also prevent errors that can happen on an ongoing basis. So investing in automation there as well is another piece of a big advantage, that the team can now skip manually tagging the transactions and just relying on automation to do that work for them. So that's just a few. And again, we will talk about AI. So there are definitely more things that can be done with automation and with machine learning, et cetera, to make sure that your forecast is more accurate and that you can achieve the goal of optimizing your cash out of it.
Okay, brilliant. Thank you, Adi. That's really helpful. Joel, I'm going to go back to you because I understand that you and your company have automated your cash forecasting at Tangoe, and I'd love to hear a little bit from you about why you decided to run this automation, how it's been working, and how it's going so far.
Yeah, so many of the advantages I listed above when you asked me about the automation apply here as well. But I cannot say that the need was actually obvious for us. I mean, forecasts were accurate enough, and we spent 3 to 4 man days per month to work on our 13 weeks, the weekly 13 weeks forecast. So it didn't cause us any delay in our day-to-day necessarily, and we supported the business. This is also when I approached the team and told them, listen, well, we don't think it will save us a significant amount of time because we don't spend as much already. However, to me, you can't think truly about transformation in finance without automation. And also, as I mentioned earlier, I really wanted people to have the higher skilled enormous amount of time on what your automation can bring us. Once we went live, the team actually admitted that the tools allowed us to save from adding additional headcount, and also set us up very well for future scale in the organization. Today, we generate the forecast, working to extend our time horizon from 13 weeks to 6 to 12 months, sorry, using the automation to allow us in the tool set the tool allows us.
Okay, that's brilliant. Thank you. And I'm kind of hearing about the automation that's running here and the advantages that it brings to your company. But I think everyone listening to this is also maybe a little bit concerned about the risks of using automation around forecasting. So I think, Adi, I'm going to start with you on this one. Are there risks involved? And if there are, how do the finance team mitigate them?
So I think we're sure that the machine that is doing it is actually performing the work accurately, and to analyze large amounts of data, there does need to be some process in way of verifying that the data was categorized correctly and that it's aligned with what you expect the business to have. So if you can see variances that don't make sense, it won't make sense to you as the finance person in the company, and only the finance team can actually understand their business and whether things make sense or not. So validating the data is one aspect that is required to make sure that we avoid the risk of relying on wrong data in our forecast as part of the automation. I think that's probably the major risk that I'm seeing. Maybe another one that we can think of is, again, relying too much on making decisions about taking the role out of the treasury or finance team and getting it done on behalf of you, but really just leveraging the opportunity of putting things in front of the team to make better decisions. So maybe a risk of over-relying on the data or assuming that it's there to make a decision for you is probably the wrong way to think about what automation or AI can do for you.
Okay, so basically the data is there to support your team, but we very much still need the work of the team to make sure that everything is accurate. Joel,
Right.
how about you? How have you seen in your implementation? What are the risks that you've come up against, and how do you see this?
Yeah, so as Adi mentioned, certainly there are risks. I'll mention a few more, but the benefits, I think, outweigh them. Adoption. The tool is as good as the people who maintain it. And if they're not embracing the tool, I see that as a risk. Kinds to it, and then the implementation can fail. The tool relies on the ability to integrate systems such as banks. So that integration and the point of integration, whether it's an API based or not, is critical. And of course, with any integration, there is a risk of failure, data not flowing, etc. And finally, as Adi alluded to it, we cannot become complacent thinking the tool can't go wrong. Either the tool does something wrong, the AI analysis is not exactly what it's supposed to be, or the person is entering manual data, fat fingering sometimes as well. So absolutely checking the data that you see in front of you and not blindly trust it needs to be taken into consideration as well.
So I suppose we've come to AI. This is a relatively new field to me and something I'm learning about, and I keep hearing over and over again about the pluses and the minuses of AI in finance. So Adi, I'm going to start with you here. Is AI in finance just hype, or can it actually help finance teams with forecasting?
So definitely not a hype. And as mentioned already in previous answers, one of the biggest challenges with forecasting and getting your treasury to be automated is dealing with a lot of data points. And that's exactly what systems and AI can be good at. So definitely we should be leveraging this new technology that can process so much data and very easily maybe provide insights more quickly into changes in the data, anomalies, foresee things that are about to change in the future based on historical behavior is definitely something that we can rely on. Having said that, we need to make sure, as we said before, that everything is validated through the finance team lens. They know the business. There are things that if didn't exist in the past, for example, and the business is changing its behavior, whether maybe an acquisition is coming, the AI that is relying on past data can't foresee a big change in the business or a big need in cash that wasn't ever occurring before. So definitely the finance team, the treasury team should be first validating the data, making sure that what it spits is correct, but also making sure that they can adjust it. The way to use AI isn't as a black box. It needs to spit out a model that can then be broken down into the pieces and deciding to pick and choose what does make sense, what needs to be changed and adjusted to the new reality as the finance team know it about their own business. So definitely leverage it, but make sure that it goes through, again, the lens of the finance team.
Okay, brilliant. And Joel, is that your experience as well with the team, that the AI actually gives us value?
I absolutely 100% agree with Adi that AI is not a hype. However, its ability to assist finance analytics is currently limited. And what I mean by that is the AI in general is as good as the data it relies on. So when it comes to analytics and explanations, many times information is not necessarily on the spreadsheet, but in somebody's head. So getting that data, and Adi mentioned it as well, I mean, it can help as long as the data is there. It's a faster tool. It definitely can see things that the human eye or the human brain misses. So when it comes to forecasts, projections, cash flow, it can be a tremendous help as it relies on historical data. And the critical piece is it needs to rely on existing historical data. It cannot, that resides in the tool. It cannot be, we cannot expect the tool, at least not today yet, to have the ability to grab data that is in somebody's head. And if we can create those connections in the future, amazing stuff.
We'll create a feature request for Adi.
Yeah, absolutely. But it's a much faster and more accurate than any human being today.
Okay, brilliant. And then my final question, Joel, and I think I'm going to ask you to take this one as well, based on your experience, is how can teams measure accuracy in forecasting, and what would reporting look like?
So I think it's, when I measure accuracy, I usually compare actuals against the forecast, actual results against the forecast. It can be a forecast we did 13 weeks ago. It can be a forecast we did a week or two ago. It doesn't really matter. The closer the forecast, of course, the more accuracy I expect it to be. Comparing actuals to forecast allows you to fine-tune future forecasts, to identify trends, to identify deviations, changes in the business that may dictate changes. For example, like 13 weeks ago, we created a forecast. 6 weeks ago, we received a huge contract that changed not only today's results, but will have a lasting impact. That's something that we couldn't know 13 weeks ago. And so if you look at that from the outside looking in, somebody who's not aware might say the forecast was inaccurate. But in case of a bluebird, it's you can't really say that. It's not necessarily in error. If we had the event that we should have expected to impact the forecast, we didn't take it into account, then I would say, yes, it is an oversight or an error. If we can bring, for example, the data from our CRM, the opportunities that we have with close rates and close dates, we can anticipate projections based on billing. All of that helps in creating a more accurate forecast. So a system that can compare historical forecasts to actual results, I think, is key in giving the team the ability to fine-tune and to minimize the variances.
Okay, thank you. Adi, I'm going to pass the screen over to you now so that you can give us a quick demo of forecasting within Panax, and then I'll take some questions that we've got here.
Okay, so talking a bit about Panax and our approach to forecasting and how it looks like today. So first, very high level, Panax connects to all of your banks and present a current view of your cash position. So you log into Panax, you see that picture, and you currently have an image of what it looks like today. Together with the balances, what we get from each of the financial institutions that we are connecting to is all of the account transactions. And that's basically the basis, as mentioned, for a good forecast. Getting all the actuals and categorizing them to the correct cash purpose that transaction was for. What we allow to do in our product is give you the ability to have the categorization be as flexible and meeting your business needs. So you can define how you want to categorize the cash. And this same categories will then be used in the forecasting to look at each of these categories and define their forecast model for future weeks or months. When it comes to building the cash forecast itself, we basically allow for a couple of options. You can build a forecast on a monthly basis or on a weekly basis, and you can decide whether you want the granularity of it to be by each of your entities and build separate forecasts that will then be consolidated into one high-level one, or just forecast as a consolidated one for the entire business. Really depends on your needs and how different the cash flows are within each entities, and whether this granularity is needed for that. When building each of these forecasts, so assuming you decided to do it for each of the entities, as mentioned, you go into each of these categories and define how these cash categories are supposed to behave in the future. And we allow for multiple ways to get the data streams in to input data into the forecast model. So for example, when I go into my collection and I want to forecast wholesales, I have multiple options. The first one is the ability to get the data from the ERP and rely on open invoices that exist in the system. And there are a few other methods that I will go into in a few minutes. So when pulling the data from the ERP, what Panax is doing is pulling each of the invoices. We're integrated into some of the major ERPs, and we, based on the open invoices in the system, put the invoice on the week that it's supposed to be paid per the due date in the ERP. You can say that you want to get this data for the first 4 weeks of the forecast, for example. Maybe you only have invoices for the beginning, and then continue forecasting based on another forecast method. And you can also go into the actual data, see what the invoices are, and override the expected date to a specific different date. So let's say if an invoice that is currently due for July 19th, maybe you are aware that this customer is usually a few weeks late, so you can adjust it to a different week, and that invoice will then be applied to that week in the forecast. Panax also today calculates averages per customer and will suggest different ways to automatically apply rules by customers. So let's say the payment due dates for specific customers are 45 days, but we see that based on historical data, the average payment days are actually closer to 60. We can allow you to adjust this and say, going forward, this customer should have 60 days as their payment days, and use that in the forecast. So we also analyze historical behavior and suggest that. So the basic layer is, as mentioned, the ERP, but not everything can be forecasted by an ERP. So for example, if you have a B2C collection, you won't have invoices in the ERP that you can forecast based on. We also allow to forecast based on other options. So one of them being a historical behavior. In this specific example, I'm looking at what are my collections on a monthly average over the past 3 months. And I'm calculating a weekly average that can then be placed on the forecast going forward as an amount. We also allow for other historical behavior. You can apply growth. You can also look at seasonal trends, etc., and use that to apply as a model going forward. Outside of that, you can also decide that maybe one of your categories is dependent on another category in terms of the cash flow. So for example, you have a payment to shipping suppliers, and maybe this specific category is relying on how much you collect on your collection category. So you can apply a rule that every week the amount that should be forecasted for this category is a % of the sales of a previous week. And that calculation will be taken on as the rule and will be populated going forward. For other categories that are maybe more consistent, let's say payroll, you can decide that you want to set a specific recurring amount and decide when this amount is due. So for example, if you pay payroll twice a month, you can place it on the 15th and the 30th, and only weeks with those days will have these amounts shown in the forecast. And lastly, you can also apply a manual rule, input your numbers, and decide to override if needed, and upload numbers to a specific category as well if needed. So let's say you're getting numbers from an external team as the forecast, or you have it on another system that is currently not integrated with Panax. You can always input it manually and use that as the forecast. After you defined all of the forecast methods, everything is then being aggregated into one consolidated forecast. If you build it by entity, then all of the entities will be consolidated into one forecast for the business as a whole. And that way you can see for the following month or weeks, the opening balance, the ending balance that is expected in each of the time periods. And as mentioned before, foresee changes that need to happen in the business and make decision based on it. Whether is I have enough money and I can now maybe move money to investment in a certain point of time, or the other way around, I need money and I need to pull from a credit line, or whether it is you want to push some payments or start making calls for your customers and ask them to pay earlier. The forecast that you've built is basically a one-time build. You define these methods, and then from that point on, we roll the forecast on an ongoing basis automatically for you. At the end of each month or week, depending on how you decided to build the forecast, you will get this summary that will show you what was forecasted for that time period, and then what were the actuals, and then the variances. And you can drill down even deeper into the variance report and see a comparison of each of the categories and what changed in them to understand what drove the biggest change. And also compare the new version of the forecast that was created compared to the previous one that was forecasted before. So when we roll, we recalculate all of the rules that you provided as part of the forecast method. So let's say you forecasted based on average 3-month historical behavior. A new month of actuals come in, we will refresh that average and we will now apply that number in the new forecast going forward. You can compare that number of the new forecast to the previous forecast and decide whether things need to be adjusted manually, forecast method should be changed, or maybe you should apply some overrides that should be because of maybe a change in the business or something that is a one-time expense that you didn't foresee before. Another report that we provide is forecast versus actuals. Joel mentioned it before, basically looking backwards and making sure that over time you are forecasting accurately and kind of looking at the trends of week over week or month over month. What was the forecast compared to actuals, and seeing as a whole how accurate you are in your forecast. We also allow managing multiple forecasts, so you don't need to commit only to a monthly or only to a weekly. You can manage both at the same time, depending on the granularity that you need. And you can also add additional forecasts that are maybe a variation of a specific forecast that you already run. This should allow you to kind of test scenarios and say, I want to rely on this monthly forecast, but adjust the collection and increase it by X% or decrease it by X% and see how it impacts maybe the bottom lines, and what will I need to do if that scenario actually happens. So we can allow you to maintain multiple forecasts and compare them one to another. Lastly, and coming soon, once we will add more forecasts, what we are planning to add is a more AI-generated forecast that will look at the past and more accurately suggest forecast methods for you, or a forecast method for specific categories for you. As mentioned before, the goal isn't to completely give you a hands-off type of experience, but help you to make the forecast more easily built and also more easily provide insights. So that's coming soon in one of our next versions of our product.
Adi, that's really exciting. And I mean, I'm excited for it because I'm like, yay, I get to launch something that's AI. So that's always fun. We just have a couple of questions. If you two don't mind staying on for another few minutes and just answering them. Joel, I have a question. I think this one is for you on how did you manage the transition to automated forecasting, and what advice would you give to someone who's going to go through it? I think you might be on mute.
I am, as
Yes.
always. Yeah. You're on mute. Yeah, the famous sentence.
Yes.
I mentioned earlier, adoption. Adoption is key. So first, the team, I think, must embrace the tool and the process. And, it's the famous sentence from the Apollo 13 mission, failure is not an option, is true for any IT projects in my mind. If you selected a tool based on a predefined requirements, trust your judgment, trust the one of the team, assume that you made the right decision. And now the goal is really to go and implement it. Don't have buyer's remorse. It's critical. Don't have second thoughts. Once implemented, that's probably when you should make sure that it does what it's supposed to do. If it doesn't, then yes, then you don't have a choice but to look at other solutions. But you need to stay on top of your vendor's roadmap, so you can anticipate new developments. You need to assess how it can help you prepare for it, and don't hesitate also to go to the vendor with requests and have an impact on the roadmap. I think it's first, it's good sense of partnership. And you don't always get what you want, but you get some of it.
But you get what you need. So it works out. Okay, brilliant. And Adi, I have a question for you. There's a question here about Panax integrations. They want to understand what Panax integrates to financial systems and banks.
Yeah, so in terms of banks, as mentioned before, Panax connects to almost each and every bank and also payments processors. So we have an array of ways to connect and get the data from the banks. And our goal is to achieve complete coverage of any of our customers' requirement banks. In terms of other financial tools, we connect, as mentioned, to ERPs, some of the major ones such as Oracle NetSuite and Microsoft Dynamics 365 and some more.
Okay, brilliant. And Joel, I have one last question for you. Somebody wants to know how your team felt about moving to automation. I think they want to know if they were happy with the decision or if they felt...
Yeah, I think I mentioned earlier, the team initially was not, but they absolutely embraced it. They saw the value. They're very happy with the tool itself. I would say yes, all challenges always are there, whether it's variances, whether it's things you don't anticipate, integration that doesn't work. And what I'm telling my team always is make a list of everything you do manually today and see how you can automate it in the tool. If it doesn't exist, go speak to the vendor. And that's true for any IT project or any finance-related system, not necessarily treasury and cash forecasting, but that probably would be my advice also to the previous question maybe. But in this case, I must say the team is very happy. It helped morale. They see absolutely the ability to do higher level work, and they have a better job satisfaction at the end of the day.
Okay, that's brilliant. So I'm just going to do a very quick sum up. So we talked a lot about AI and about automation within cash forecasting. We talked a little bit about the risks and the challenges around implementing it, but also the value that it can give, more efficiency, helping people to work better, and also happier workers, which I think at the end of the day is just as important to us as having efficiency and teams that work well. Adi and Joel, I'd like to thank you very, very much for your time. This was really wonderful. And to everybody who's listening, thank you for joining us. We'll be sending this out afterwards. And we look forward to seeing you at upcoming finance conferences in Nashville, in Copenhagen, if you'll be attending those, and also on future webinars. Thank you very much, everybody. Have a great rest of the day.